Hey everyone, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm going to be talking about some of my key takeaways and things that I learned when I was at the Diversified Mortgage Expo or DME within this past week or so, depending on when this airs. But before I get into that, I want to let you know I wrote a new free ebook on investing in notes in 2024. It's free, it's about 10, 11 pages. I think it ended up, but what I did in this was a lot of times, people talk about note deals that they did like 10 years ago or 5 years ago, and market conditions change all the time. And so what I did was I profiled some deals that I closed this year, just in 2024, with the exact numbers and some of the returns that I'm projecting and pricing that I got and how I found the deals. And then also have a couple of case studies in there of deals that I recently exited. Now, granted, the ones that I exited were ones that I entered into in 2023 and behind, but I think it gives you a pretty good view of the current market and some of the good opportunities that are available. So if you want to check that out, you can go to fusionnotes.com/subscribe, and you can subscribe to my newsletter and get a copy of the totally free ebook. So now talking about the DME conference, there aren't a whole lot of live conferences and notes available. It looks like Paper Source is probably not happening anymore, and at least as far as I know. And so that kind of leaves us with DME and Note Expo. So originally I wasn't going to go to this one because it was kind of sandwiched in between my daughter's high school graduation and another trip that I have planned. But I decided these live events are so valuable, it was worth squeezing it in. And I'm glad I did because I really learned a lot, met a lot of cool people. So starting with, things that jumped out at me. One, there were actually quite a few Colorado people there. It's interesting. There are more people who do notes in Colorado where I live than you might think. And so when I started in notes, there was a Denver note meetup run by Beth Hale. That was terrific. It really helped me get started. It's where I met some of my first investors and actually some people that still invest with me. And so I've been considering reviving that group. So if you're in Colorado or the Denver area specifically and you're interested in that, please drop me an email, dan@fusionnotes.com, and let me know. Like I said, I haven't committed to reviving that yet. Maybe it's a 2025 thing, but I'm definitely thinking hard about it because I think we got a pretty good critical mass in the area. There were a lot of a lot of the usual suspects were there, like people that I see at all the shows. There are also quite a few people that were brand new to notes, and then also a lot of what I would call almost like under the radar people who have been doing notes for a while, but kind of on their own, and some of whom didn't even know that there were events like that went on. Did hear a few bad actor stories. That's always been somewhat of an issue in the industry. So some kind of new bad actors and some updates on some existing ones. And so within my Note Launchpad course, I've got a bonus video called Scam, Scandals, and Shadiness, where I actually outline some of the people to watch out for. And so I think a little bit later this summer, I'm going to go back and update that video. That's one because it's obviously a sensitive topic. I've got that behind a paywall. I don't want to create legal or other issues for myself by putting that out publicly, but I definitely want people to be aware of certain folks. So look for that update sometime later this summer. And my overall takeaway of the notes business, like I said, it's really interesting cast of characters. Highly entrepreneurial folks, very motivated folks doing some very cool things. And it was really fun talking to people about all the different business models that they have, some of which are very different than mine. One of the cool things about notes is there are so many ways you can make money in it. And, not just different ways to make money, but as the market evolves and conditions change, there's ways to evolve your business model to make money in just about any environment that you might come across. I would say, and I also did some thinking about how I'm making money now and mostly performing and sub-performing notes. I'm opportunistically buying some non-performing notes, primarily first position, but starting to do some second position. But then I'm also starting to noodle through, okay, how would I change my model if there was more distress in the economy, or if interest rates changed either up or down? And it's tough to come up with an economy where there's not really a good solution for making money in notes. I would say the toughest economy would be one where the economy's hot, the stress is low, unemployment's low. And that was really the market we had around 2021, 2022, and I was still able to find deals in that era. Granted, during that time I did fewer, I was a little more opportunistic, and that's why I was focused on a W-2 at that time. Now that we've got more deals available, that's part of why I shifted back to full-time a little bit earlier this year. So for me, it's a good sign, because if I was able to make money in what I've tried to define as probably like the toughest market, there's only, good things ahead, kind of no matter what the greater economy does. Um, let's see. So what's next here? Yeah, I mean, just some of my thoughts on the general note investing ecosystem and people. Some people may or may not know I used to play a lot of poker back in the day, up until about 2011, when a lot of the online stuff went away. And I think that the note world of today kind of reminds me of like the poker world as of the 90s. It's kind of small, it's kind of nichey. You've got a handful of experts, and obviously the people that know what they're doing have a gigantic leg up on the people who don't know what they're doing. But at the same time, even the people who are experts, I'd say there's still an overall lack of sophistication in the business. And my personal prediction, and I talked about this in an earlier podcast on the future of the notes business, I think we're going to see this evolve. And I would say, I don't want to say professionalize, but I think some of the tools and processes that note investors use are going to get a lot better. They're going to allow people to scale. I'll give you one example. There was some discussion in the conference, and this always hurts my head when I hear this, but there was a lot of discussion even from the stage on financial calculators and the right ones to use. And there's nothing wrong with using a financial calculator to give you the right answer, right? Like, you can run a very profitable notes business using nothing but an HP financial calculator and a legal pad and a landline telephone. Like, you could totally do that. It's fine. But the reality is there are much better ways to do it. So if you're pricing notes, you're doing deals. I mean, use a calculator when it comes in handy for certain things, but in general, you should really be using spreadsheets for a couple of reasons. One, when people use calculators, I've noticed they tend not to factor in their costs. They tend not to factor in their servicing costs. They tend not to factor in their upfront costs. Because when you punch that into a calculator, like, it's a little bit tricky, right? It's easier just to say, okay, my P&I is $500 instead of my P&I is 500 minus 42, or whatever your servicing cost is. The nice thing when you put it in a spreadsheet, you can just plop all those costs in there. Your answer falls out. And then more importantly, if you want to make a change to your analysis, instead of starting from scratch, punching everything into the calculator, punch, 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 and picturing somebody with a keyboard, like with two fingers, you just change a number in a spreadsheet and everything updates, right? So if I'm going to service this at Allied instead of FCI, my servicing cost goes from $35 a month to 18 and a half or $25. I just change the cell and I get the right answer. The other place this comes into play is when you might calculate a return that you need on a certain note and then back into a price. And then lo and behold, often when you make an offer, you get a counter offer, right? So it's really easy if you have that in a spreadsheet, if you get a counter offer, to plop that in and see what your new return would be and see if that's acceptable or not, right? So again, nothing wrong with using a calculator, but my God, like it's more work than just putting it in a spreadsheet. So just make life easier on yourself. And much like that old poker world, though, the poker world kind of transformed over the last 20 years or so, right? So if you look at the people like 25 years ago who were the best in the world, they would get playing the way that they did back then, they would get annihilated by the best players now because the whole game has been elevated. People have figured things out. People have gotten better. People don't abide by the old rules of thumb. They found better ways to do things. And I think people are going to continue to find better ways to do things in notes. I know there's a lot of talk about AI and things like that. And I think, my take is I'm actually, as much of an engineer and much of a background I have in the tech business, I'm actually a little bit of a late adopter to AI. There was also some discussion about what people are using AI for. I tend to use it just for writing. I'm an engineer and a math guy. I'm not much of a writer, even though I wrote a book in the past. And so it's handy for me just to kind of clean up a paragraph where it says the same thing I meant to say. It just says it nicer and good for fixing spelling and things like that. I know there are folks, working on things, AI solutions for due diligence and things like that. Alex Godofsky talked about a little bit of that on the podcast a few weeks ago. But my God, like if people can't transition from a freaking calculator to a spreadsheet, which most people did in 1985, I wouldn't worry about AI taking over everything real soon. Okay. So, but I think it will over the next many years, but it's not going to be like in this next year or so. Um, what else? So financial calculator. Yeah. Met a lot of new people I had never met before. Some of whom were kind of brand new to notes, but then there were a lot of people who have been doing notes for years, but never participated kind of online in any of the Facebook groups or bigger pockets or showed up to any of the events. Like I talked to one gentleman who's been doing this for years. And he's like, "Oh, I didn't even realize anybody else did this. Like I thought I was the only guy that bought non-performing notes and worked them out." So it's really interesting talking to folks like that and folks who are just really smart and just kind of went in there and figured it out like all on their own. That was super fun. The other thing that kind of struck me talking about people with different business models, I talked to at least three people, maybe it was more, doing non-performing notes in New York. Um, I've never done any notes in New York, and I've always advised strongly against doing notes in states like New York and New Jersey's that can have really long foreclosure times and really uncertain foreclosure times. But it was kind of eye-opening how a lot of people do it, right? And what they do is, because quizzing them on this, they just go into it with a lot of patience, understanding that their timeline is going to be extremely long, and they don't buy the deal unless they get pricing that reflects the risk they're taking and the amount of time they're going to be in the deal. So it shows me that maybe I've been like a little bit closed-minded about some of the opportunities. Um, there's certainly a lot of different ways to skin the cat. And the more I thought about it, it's like, yeah, there are ways to make money in non-performers in New York. Now, for me, that doesn't mean I'm going to run out and do any, because I think that requires a little bit of a different model than what I've used. And I think there's also a lot of value in kind of picking a lane and picking, call it a play, like out of your playbook, and running that over and over and getting really good at it versus trying to do every little thing, right? So yeah, there might be notes in New York that could potentially be good deals. I'm not necessarily going to go chase that because I'm going to have to do a lot more work to figure that out. And it's going to maybe distract me from some of the things that I've been doing so far this year, right? So far this year I've closed, I think 15 or 16 notes so far, and most of those have followed a similar pattern. performing and subperforming first, although a couple of them were non-performers. The other thing I had an interesting conversation with some people about was about how, on one side of my mouth, I just said, kind of pick a lane and stick to it. On the other hand, if you talk to the people who have bought notes over many, many years and seen many different kinds of market conditions, I think it's also important to be flexible and be ready to evolve your model over time. So, you hear a lot of people talk about case studies from 2014 or 15, where it's like, oh, you buy a non-performing second with negative equity for pennies on the dollar, and then sometimes you strike it rich. Well, deals specifically, there are good non-performing seconds you can buy, but deals specifically like that, where they're upside down, you're not really going to see in this market. Or if you see them, it's going to be a little bit of a one-off, right? So if you do pick a model, there are times where you have to change it. It's not going to be every month. It might be every few years, but like pick a lane and stick to it, but then be flexible and ready to change when the market conditions adjust. It's always really fascinating talking to people who have been doing this for like 40 years through a really wide range of markets. And like I said earlier, there's a lot of ways to make money in almost any kind of market conditions, provided you just adjust your model accordingly. I didn't listen to too many of the talks. I spent most of the time in the hallway talking with people. That's mostly what I do at conferences, but I did listen to a few of them, and there was a guy there from the MBA. What is that? The Mortgage Brokers or Mortgage Bankers Association. That's something I should probably know. And he had some really good, I missed half the presentation. I need to go back and get the rest of it, but he had some really good macroeconomic statistics, and I really like to nerd out on that stuff. I like that kind of 30,000 foot view of what's going on in the economy and the market. And he had some interesting tidbits in there. One thing he called out is there's still relatively very low levels of distress in the market, right? I mean, if you look at the delinquency rates for residential mortgages, they're historically pretty low still. However, what you are seeing are some big increases in tax and insurance payments required, especially in some key states like Texas, Florida, California, and New York. And so as those insurance rates and property tax bills continue to climb, I think at some point that's going to create some distress. It's probably certainly going to create some tax lien opportunities. Tax liens are something that are outside my lane and I haven't got into, but I think at some point something's going to give. Like housing's been very strong, and it's definitely aided by the fact that unemployment is low. So historically, delinquencies on mortgages tend to track with the unemployment rate. So we've still got low unemployment, and we've still got high housing prices, and so mortgages have a lot of equity. One of the interesting things was that he was showing delinquency rates of different types of debt, and credit card delinquency is starting to ratchet up a bit. So we'll see if credit card defaults are kind of the canary in the coal mine or not. It's interesting because when you follow the data back and you look at what happened before the financial crisis, actually mortgage delinquencies led. Credit card delinquencies stayed low for a while. I think we're not seeing that now because borrowers have so much equity, whereas back then people started getting upside down. So it's always fun to track that stuff. Again, mortgage market's fairly stable, low delinquencies, but there are these stressors in there as well. So I'm not predicting any impending changes. I'm absolutely horrible at doing that normally, but it's a good thing to keep an eye on. And then the other thing I've been thinking about, there's a little bit of discussion about, not too much, was the impending commercial blow up, right? Like there's a lot of bad commercial debt out there, and I feel like banks are kind of kicking the can down the road, and at some point that's going to come to a head. I don't know if that's next month or if that's like 5 years from now. It's hard for me to predict. There are also some people out there buying defaulted commercial loans It's another area I'm interested in because I feel like there's going to be a lot of opportunities coming down the road, but that's something I've not gotten into yet. But it was fun picking people's brains about that. Tends to be, fairly hyper local. So we'll see if I'm able to put together a model for doing that out of state or not. Yeah, the other thing that came up a lot was hypothecations. That's something that I do a lot, and for a while I was beginning to think maybe I was the only person doing it because I had talked to a lot of other people who had. And if you're not familiar with that, maybe I'll do a deep dive episode on this sometime too this summer. Send me an email or make a comment if you're interested in something like that. But a hypothecation is when you go out, you buy a loan, so you buy a performing loan, and then you take a loan from an investor using the first loan as collateral, right? So you're kind of refinancing yourself out and you're basically borrowing at a higher interest rate. Or so you're buying at a higher interest rate and borrowing at a lower one. You're creating a little bit of a spread and you're keeping the upside in case you get an early payoff. But that's been an extremely popular tactic. There was a lot of people doing that, a lot of discussion about that. And even at least one person who was able to get that kind of funding through a bank. Now, that had a bunch of caveats that go with it. That's not an easy thing to do, but that's definitely a pretty popular tactic. The other thing, there's also a lot of discussion around seller finance. Sounds like all the RMLOs are pretty busy doing originations. I think part of that is just the banks are in super risk off mode as they have this, pending commercial calamity staring them in the face here at some time. And then also some folks doing interesting things, right? Like there's some folks who are working with originators to buy seller finance loans right as they're originated. So they're basically called table funding, right? So they're kind of coming in, literally like a bank would in a traditional transaction and doing the funding. That's kind of anathema to a lot of note investors because when you're doing that, you're paying par, right? So for one, when you do that, when you table fund, you're paying par, there's no discount, so you're not getting the upside, and it's newly originated, so there's no seasoning. And that seems like really grotesque to a lot of people, but it can make sense, especially now that interest rates have climbed, right? And so, while the bank originated mortgages might be at 7 or 8% or whatever it is, I haven't looked lately. A lot of these seller finance ones are getting created at 11 or 12%, right? So assuming it's originated well, the paper is clean, there's a big down payment, like a lot of times like 25%, getting 11 or 12% isn't too bad. And then if you can take another loan against it at a lower interest rate, you can kind of lever up your return a little bit as well. So lots of great strategies that other people are doing. So definitely gave me a lot to think about. So that's what I've got for you today. Hopefully that gives you some good ideas. And I will see you guys next time. Thanks.